All right, now we're live. So nobody's here yet though, because we're starting a little bit early. But I'm going to go over to Facebook. So if
Okay.
you guys are watching on Facebook, I'm going to go and post the link to the YouTube video. It's just easier to have more people in one place rather. So let me know in the comments here, like whether you're on Facebook or on YouTube, so that we know. And if you're on Facebook, your name doesn't actually come up. So it's always fun to know who you are. So if you come over from Facebook to my YouTube channel, I'm also just going to go into Facebook right now and just post the link to join the actual YouTube channel. I don't know why I post on Facebook. I think it's because it notifies a lot of you guys to come and watch, but it's much easier just to do it on the on YouTube. So I just posted the link to come and watch us on the YouTube channel below the Facebook thing. So I can see there's a couple people on Facebook watching and the rest are on YouTube. So that's cool. So say hello in the comments, guys. This is going to be an awesome night. I'm really excited to have Stephen on. I met Stephen. Hey Raj, how's it going? I met Stephen, a few months ago now? Time goes fast. So
Yeah.
it feels like I kind of, all right, hey Casey, how's it going? Yeah, so I met you through Lance. So Lance from Theta Traders did an interview with Stephen probably a month or two ago now.
Yeah, that's about right. Yeah, a month or two ago.
Hey Daniel, how's it going? Hey Raj, hey Casey. So this is a system, and I'm super excited about this because it's a little bit different from a lot of the other stuff that we do, sort of in the Discord niche that I found myself being part of with Lance and Matt and then Psychic Traders and stuff. So I'm really excited to see this very novel strategy, and it's an advantage. There's definitely a twist to it, which makes it pretty appealing to a lot of people. Hey Glenn, how's it going? Seeing your comments there. Pretty good. So yeah, so the idea tonight is we are going to do a presentation. At least Stephen is. So Stephen's going to give his presentation and you guys can ask questions whenever you want. I think there'll be plenty of time for it. It's not a long presentation. But then we want to really show you kind of what Stephen's been working on, which is an awesome app as well for this, which makes life so much easier and allows people to find their own options rental income system, or trades, or ORIS as he's calling them, which I love the acronym, by the way. It's cool. You also have Iris now as well, I noticed on the Discord.
Yeah, it just came out with Iris. I thought we'd continue on with these four-letter acronyms, but
yeah,
to make it interesting.
Yeah. I see a few more people piling in here, so that's good. So we're going to get started pretty soon. I think I want to do a very quick introduction. I think this idea that using stocks as a rental income strategy is super excited. You guys probably saw some of the emails I was sending out about the horror stories I've had as a landlord, and I'm sure some of you that run rental properties and stuff have had several very similar experiences of crazy tenants and things. So I love this analogy, and I think you've done a really great job, Stephen, of really putting the case for doing something like this as opposed to rental income from rental properties. So it's going to be pretty cool. All right, shall we get started? I can put this full screen. You can kind of introduce yourself and.
Sure. Yeah. So hey everyone, I'm glad to be here. Thanks Russell for inviting me on. So today, as Russell mentioned, I want to talk about the options rental income system, which I refer to as ORIS as kind of shorthand. And just a little bit about myself. So I'm Steve. I've been investing in the markets for a long time. Got started 20 plus years ago. I was very young when I started investing in stocks, but it wasn't until 2010 that I actually started reading about options, started trading options, and I was hooked ever since then. And options pretty much the bulk of what I do now. So just a quick disclaimer for any presentation I do. Always good to have one of these, right? So there's my little blurb. So I want to introduce ORIS to you, but I want to ask you a few questions before I get into things. Have you ever wanted to start a business? Have you ever wanted to start a side hustle? Or have you ever wanted to own rental properties? And for me, the answer to these questions was always yes. I mean, this is what I wanted to do. And a little while ago, it kind of dawned on me that I could do all of these things using options. And so let me explain. Well, my last question is on this other slide. Have you ever wanted to do Airbnb or Turo? I've been interested in that. I've looked into that as well. that kind of business model, the short-term rental business model, seems very appealing. It's easy to understand. And so that kind of factored into the development of Oris. So if you answered yes to any of these questions, you may be interested in Oris. So what is Oris? Oris is an acronym, as I mentioned, for the Options Rental Income System, which is a poor man's covered call plus a set of rules. So it's the combination, I think, that makes this powerful. It's not just a poor man's covered call or diagonal spread, as it's sometimes called. It's also the set of rules, which is very important. And the basics, well, there's two parts for those of you who may not be familiar with diagonal spread. You've got a long call option that's typically long in duration. In the case of Oris, one of my rules says that you've got to have at least a year until expiration, and you want to buy deep in the money. So we're buying 85 plus deltas, which is pretty far in the money. And then we're also simultaneously selling a short call, a short duration call, 30 DTE typically, and that is right at the money, right, which is going to have about a 50 delta. So have I lost anybody?
Don't think so. Nobody's asked any questions yet. They're all talking about rentals, and Raj is saying he wants to do a blockbuster. So yeah, that's probably not going to work, Raj. But yeah, everybody seems to be watching and just listening. So
okay, great. And feel free, if you have questions, type them in the chat as we go. I don't mind being interrupted. So, but before we move any further into Oris, I think I kind of need to lay the foundation of how this is similar to a short-term rental business model like Airbnb or Turo. So as you all know, the basic business model for these short-term rentals is you buy a long duration asset like a house, a vacation home, or a vehicle, right? And then you rent that out on a short-term basis, monthly or weekly. And you all you have to do is maintain the asset pretty much and keep renting it out. Well, we can kind of do the same thing. This is kind of the epiphany that I had, was we can kind of do the same thing with stocks, right? And how can someone collect rents on stock? Well, you own shares, and then you are essentially selling or renting the upside potential for a period of time, 1 week, 1 month, to somebody else in the marketplace, right? And this is what I've just explained as a covered call. So if you're not familiar with a covered call, Google it, but it's a pretty easy concept. So you have 100 shares of stock and you can sell a call option off of that. And you're basically selling the right to your shares at or above a certain price. And then in a minute, we're going to talk about a variation on a covered call, which is my personal favorite, and that's the poor man's covered call, and that's the basis of Oris. But in order to understand the poor man's covered call, we got to first understand the covered call, which I'll get to in just a second. But going back to our analogy to Airbnb, what are the pros and cons of renting stocks versus something like Airbnb? Well, there's no cleaning or repairs that are required, right? There's no dealing with toilets or people, no advertising. It takes, in my opinion, a lot less time and energy. You do it from the comfort of your own phone, right? You don't even need to leave your house. You can literally do it from anywhere. And but the cons, everything has cons. It can be a little bit complicated. There's a little bit of a learning curve at first, and that's what I'm trying to help people get over, is the learning curve and get through it quickly. And so it does require some education and training. And as we've seen this last year, stocks can be quite volatile. So unlike Airbnb or just being a landlord in general, you're not constantly bombarded with the price of your asset, right? But with Oris or any investing, especially options investing, every day you're bombarded with the current price of your asset, right? And that can be psychologically draining to most people, I'd say. So that is a con, and that's just something that I think takes some getting used to, some training. If you saw your house price over this last year on a live stream, right, we'd probably be freaking out a little bit.
Yeah, totally.
And so let's go back to covered calls. So what are covered calls? I kind of explained that to you here on the screen. I've tried to lay it out. As mentioned, you buy 100 shares and you rent your upside to Mr. Market for a specified period of time, whether that's 1 week, 1 month, by selling a call option. But in order to understand, really understand covered calls or Oris for that matter, this is one thing that I find is probably the most difficult thing to get across. And that has to do with understanding the difference between intrinsic value and extrinsic value. So I'm assuming a lot of you have experience with options. And so maybe this is not new or novel to you, but just to reiterate, so let's say I have a $10 stock. Can you see my writing on the screen, by the way?
Yeah, I can see $10.
Okay, good. I just want to make sure that this works. So you have a $10 stock, okay? And let's say you buy the $5 strike call, okay? And let's say you buy that for $6, okay? So your intrinsic value, so this is, the $6 of value that you paid for your option. The intrinsic value is how much? Does anybody want to guess?
Let's see, $10 stock by $5 strike.
Yeah, if I had different colors, I don't have different colors. I'm not that fancy, but yeah, so $5, right? So if you're at the $5 strike, you paid $6 for it. That means 5 of it's intrinsic and $1 is extrinsic value, right?
Yep.
And another name for extrinsic value is time value. All right, this is all intrinsic value.
Lance piped up $1, but he's kind of late. So
what was that?
Oh, Lance just piped up $1.
Okay.
So he's
Lance.
right. He's just a little bit behind.
And you probably can't read my handwriting. It is harder to write on a computer than in real life. It's it's a little bit difficult. Anyway, so just we need to understand that to understand this whole rental income system, because the rents that we collect, it's not necessarily the full premium of the short call that we sell. Sometimes our short call will be in the money, and so you really just pay attention to what portion of your call is extrinsic or time value. That's really the rent that you collect. And for an at the money call, 100% of your call value will be extrinsic or time value, or an out of the money call as well. But those in the money calls is where it gets a little bit tricky. So just wanted to point that out.
Cool.
So back to covered calls. So I think I've kind of hit this pretty hard already, what a covered call is. But this is what I wanted to reiterate, right? So the rent we collect will always be the amount of the option's extrinsic value. It's the time value. So no matter what happens, as long as time continues to tick forward, we will collect that extrinsic value. It's guaranteed. Like, yep. It's an immutable law of the universe. You will collect that time value. So in short, right, we become time harvesters essentially with this strategy. So we are just collecting rent each day as it ticks by. But that doesn't necessarily mean that every trade is guaranteed to make a profit, because the time value that we collect, it could be offset by losses on, if it's a covered call, by losses on the shares, the 100 shares that we own. So if the stock really tanks, then you could still have a loss if it tanks more than the value of your time value.
Yeah, and that's something I've always been frustrated about. Same with dividend stocks, like where you're making a dividend, but the actual underlying goes down, and you're like, okay, this sucks, you know. So
Right.
I think that's the interesting part for me, is how you get around that. It'd be interesting.
Yeah. So part of Oris, right, is kind of protecting our downside, and the goal is to reduce the risk of permanent loss, right? So there will inevitably be losers, but we're trying to limit that. And we have a course in our Discord where I talk about, different strategies to limit that. We do some hedging, so you can basically take some of your rent that you collect and use maybe 25% of it and buy a hedge, which would give you another, 5% downside. So if the stock goes down, more than you thought, you'd still be covered. I think everybody has a covered call or understands a covered call.
Yeah, I bet they do. So I'm
I think I'm
recognizing.
going to skip this.
Yeah, I think I'm recognizing most of the people in here, and I posted a link to some covered call, like a mini course. So if people don't, they can always go and do that and come back
Okay,
to
great.
or whatever. So I do think we're talking to a bunch of people here who really do understand the basics of covered calls. So I think we're solid in that. It should be good.
Great. Okay, good. We don't have to go over that. So this is just a little chart that I put together. This is kind of a general rule of thumb. Returns on covered calls. It really depends on the underlying volatility, implied volatility of the options you're selling. So if you're selling an option that has, very high implied volatility, like 70%, you're going to collect more in time value than you would if you sold a call on a stock with like 30% volatility, right? So that's just it kind of works out nicely. It's about, 1/10 of the volatility is what we would collect over a 30-day period, 30 DTE.
Yeah.
Realistic returns on covered calls, in my experience, 3 to 6%, because most stocks are probably in that 30 to 60% implied volatility range. But there's stocks move up and down, and like I said, if it's in the money or out of the money, you're going to collect less premium. So let's say 1 to 3%, right? And so is there a way to do better? Well, you could leverage up, which I don't recommend, right? You could have a margin account, or you could borrow money on a home equity loan and then run some covered calls. I personally don't recommend it. I just don't like leverage. So I just don't want the possibility to blow up my account. Or you could use a strategy, which is what Oris is based on, is poor man's covered call. And so you can make, the percentages that I'm seeing are 8 to 12% of capital at risk. But then again, because of the volatility of the market, you're not going to be able to every month sell at the same at the money strike. So you might be selling an in the money call, or you might be selling an out of the money call. So you're collecting less than that 8 to 12%. So that's why, my experience of about 2.5 to 3.5% per month, I think is realistic, which is still like really good.
Oh, totally. Yeah.
Nothing to sneeze at.
Yeah.
And so this is probably, the audience we have here. I'm sure you guys are all familiar with the poor man's covered call. We're just swapping the 100 shares out for a deep in the money call. So that deep in the money call is our proxy for 100 shares. And like I said, I like 85 plus delta. So you're getting 85 plus % of the movement of 100 shares. And that pretty much will guarantee that on the upside, you're not going to go negative. If the stock goes up a lot, you still won't go negative. And then we're selling the at the money call. Any questions so far?
The only question we've had is, can we give John a deal? John wants a deal to join, so we'll talk about that in a little bit. But yeah,
yeah, we'll talk about that in just a minute.
Yeah.
I think we do have a deal. So I just explained all of this. I should be looking at my slides that tell. Actually, it doesn't show me the next slide. It's showing me the same slide for some reason. So I can't anticipate what the next slide's going to be. So we already talked about that first part. So the reason, why do we sell the at the money call? That's where the time value is the greatest. I mean, if you look at any option chain, and a lot of you may not know this, but in Thinkorswim, if you're using Thinkorswim, I'm sure other platforms have this as well, but you can add a column or a field to your option chain that is extrinsic value, right? So it will just show you what the extrinsic value is. And so I like to have that up there because I just interpret that as what rent am I going to collect from selling this call? Because that's always going to go to zero, trickle down to zero. So at the money, it's greatest. So if you look at the option chain, it'll be greatest right at the money. And then, if you go in the money or out of the money, it decreases.
Cool. I think this is an important slide. I think the idea of using less capital and things is really cool.
Yeah. So the reason I like PMCCs over CCs, right, is because you use a lot less capital, typically 1/3 to 1/2 the amount of capital. And that's not to say then that you should do 2 of these. Like right. I actually tell people not to do that. So just because you're saving the cash doesn't mean you should do twice as many or 3 times as many. So, but what that does allow you to do is it allows you to keep that extra capital in cash. And so when you need it most, like in a crash situation, you'll have it there. I mean, that's what really helped me juice my returns in 2021 after COVID. So I had like 40% in cash at that time. And so I really became a believer in this. And that was probably the best year I've ever had, right? Because I was able to buy a lot of things on sale and just had the cash to do it. So that's what I recommend and that's another benefit of this strategy is when things really tank, like you'll have the cash available to take advantage of it. And then if you think about it, the second point here, the poor man covered call has a built-in like positive delta exposure ratcheting down mechanism. I don't know how to describe that in a shorter way, but essentially, right, if you think about delta, and then I guess this kind of goes to this third point here too. They're very similar. Your delta will fall as the stock price falls. That's true with any long call option. So, originally you might have the 80, your long call is an 85 delta, right? And if the stock drops pretty significantly, it might be a 70 delta and eventually a 60 delta and 50 delta, right? So you are every dollar down, you're losing less and less money. Whereas if you had a traditional covered call with 100 shares, every dollar reduction in price, you lose $100 from those 100 shares. And so it naturally just saves you money. It prevents you from losing the same amount that you would from a covered call. Does that make sense?
Yeah, totally makes sense to me. And I'm only seeing one question from John, and it's a fairly basic question. We could take a little time to address it if you want to. Seems like a good point to stop, but it's I just put it up on the screen for you. So what is the difference between selling a call and buying a put? Like the advantage of one over the other, since essentially you're betting the stock goes on both kinds, goes up on both kinds. Sorry, I'm a noob. No, it's fine. It probably doesn't take very long to answer that at all. I think,
yeah. So the difference between selling a call and buying a put. So if you buy a put, then you have exposure to the downside. So you gain as the stock price falls, and your profit potential is a lot higher, I guess you could say. So let me just illustrate with an example. So if you had a $10 stock, right, and you bought a $10 put, you in theory, if the stock went to zero, then you would profit $10 per share, right? Because you are basically buying the right to sell your shares to the market at $10, no matter what happens. So you would profit $10 if it went to zero. Whereas let's say you sold a $10 call, maybe you collected $2 for that call, right? That $2 that you collected for selling the call is your max profit. So the most you would be able to profit, even if the stock went to zero, is the $2 you collected from selling the call. So there's just a little bit of a difference in profit loss profile, but they are both have negative delta exposure, right? So they make money when the underlying price falls.
yeah. Cool.
Okay. So I thought here I would just illustrate an actual Oris trade that I put on last week. So
Cool.
let me see if I can switch over to my whiteboard here. All right. So and actually, I'm going to come back here. I have a different whiteboard. All right. So this is a screenshot of a chart that I pasted in here. And this is a stock called Tapestry. So if you're not familiar with Tapestry, they own the Coach and like what is it, Kate Spade brands, like luxury, handbag brands. Some of the other brands they own, I honestly have never heard of, but they're a luxury brand that Coach and Kate Spade that you buy very expensive handbags. Anyway, their stock price has fallen quite a bit this year, like most stocks. And it just kind of came up on one of the Oris screens. This is actually the app that we have created for Synthetic Yields. Through that app is where I kind of found this this name. It kind of passed all the different screens that I have. And so I put an Oris trade on. And what I did was I'm going to move this a little bit. Sorry. Give myself a little bit of room. So what I did was I bought the 1750 call option that expires in January 2024. Okay, so
Wow.
That's quite a ways away. That's more than a year from now, right? And I paid about, I'm just using round numbers here. The numbers were slightly different, but I paid $15 for that, or $1,500 for that, right? And then I sold, and at the money, at the time when I placed this trade, it was just a few days ago, the stock was trading right here at this this $32 level. Just draw that. So right there at the $32 level.
Perfect.
And so I sold that $32 call, and I got about $1.50 for it. Okay.
Yep.
So it's about 10% of what I paid for the Leaps call, right?
Okay.
And so since then, you can see here that the stock price spiked up quite a bit, just like the very next day, which was lucky, I guess. And so this trade's already about $80, showing an $80 profit. But what I wanted to illustrate is at these, let's do green. At various levels, for example, 10% out of the money, 10% in the money, which would probably be, you know, right here at $35 would be about 10% above. And then right here at maybe $29 would be 10% below. And then let's even do 20%. So up here at about 38 would be, this is 20% above where I started. We're talking about where I started at the $32 mark. This is 10%. This is minus 10%. And then here at 26 is about minus 20%. So the way the math works out with Oris, as the price bounces around, you're going to collect different premium. You know, let's say it comes down here to this minus 10%. If you sell a $32 call at this point, it's out of the money. And so you, based on my kind of research, you would be able to sell that $32 call for about $50 instead of $150. So you collect about a third of the premium there. When the stock is down here, this negative 10%. Same with positive 10%. If it was up at positive 10%, you would collect about $50 of time value. But if it's back here at 32, you'd be able to collect another $150. Okay, so you're kind of when you run this strategy, you're kind of hoping the price stays around your original short call strike price of $32. Right? That's where you make the most money. And then let's say it shoots up to, you know, so now your call is $20% in the money. Up here, you would only collect about $20 of time value, right? And down here, you'd collect about $10. So just wanted to illustrate with Oris, you're collecting premium kind of no matter where the stock price is, but the further away from your original at the money strike, the less premium you collect. But even if, let's say this was the trajectory that the stock took over, you know, 1, 2, 3, 4 months, right? You still collected, you know, your original, got to put my original 150 back here. Collected 150, then maybe you collected 50, another 50, right? That's a total of 250 plus another 150. That's 400, 420. So you collected $420 over 4 or 5 months, right? And you paid $1,500 for this original Leaps call, right? So now you're approaching like a 30% return, and it's been 4 months.
Pretty nice.
Okay. So just wanted to illustrate that. So let me go back to the presentation here. So, you know, I just wanted to illustrate the power of compounding because a lot of trading groups that I've been part of in the past or followed in the past, you know, everyone's just chasing that 200, 300% return on one trade, right?
Yeah.
But my personality gravitates more towards a strategy like this where I just want to slow, you know, 2.5% a month is really, if you think about it, is not that slow. That's like, it's pretty dang fast as far as growing your account, right? If you can do that consistently over time. And so here I've got a chart that shows you compounding $20,000 at 2.5% per month. You basically double your money every 2.5 years. So in 10 years, you know, you'd have 360,000. And the same on this next slide. I just changed it to 100,000. You know, for those of you who might have bigger accounts, that, you know, this would turn into, you know, 1.8 million over 10 years if you were able to do that consistently.
Pretty awesome, yeah. And we have a quick question for you, and this is
Yeah.
a question that comes up on all of these, and rightly so. Is how do you manage a trade when things go horribly, horribly wrong? So if something happens like earnings or a binary event and stock just drops 20, 30%, what's the plan?
Yeah, no. That's a very good question because I've had that happen during this year.
Yep, I bet you
Right.
have. 20.
One trade that comes to mind is Intel. I was talking to Lance about this the other day. Intel is probably the worst trade of the year for me because Intel essentially fell from $45 to $25 pretty quickly there. And so, yeah, I mean, number one, when you're using a poor man's covered call, oftentimes if you had a big drawdown like this, you're going to lose less than you would have if you just did a plain covered call with 100 shares. So you kind of have a built-in stop loss to your poor man's covered call, right? So you spent a third of the money that it would cost you for a covered call. So the most you can lose is what you put in, right? So which is nice. And we're going super far duration. So you actually have quite a bit of time for your stock to recover. So that Intel Leaps call, I still have it. And over the last couple of weeks, Intel's actually gone from like 25 to 30. So it's bounced back a little bit, and it still has a year plus till expiration. So if you still like the name and still believe in the thesis, you can still hold on to it. That's the second point I'd make. The third is what I talk about in the Discord is there are some strategies to kind of recover from something like that if you still believe in the stock, right? If you don't, and if you think the thesis is broken, then I just recommend that you sell whatever remaining value you have in your Leaps option and move on to something else. And I guess the fourth thing to say is the I think we have 10 rules of Oris. So there's like the 10 commandments, I guess you could say. I think it's rule number one. I actually have it in the slide deck here, but rule number one is to keep
cash, right? 40%.
yeah,
cash.
keep 50% of your account in cash at all times, right? So that helps kind of protect you from blowing it up. The second one is about position size. And so I recommend that you don't put more than 10% of your investable account or your investable dollars, which is half of your account, right? So it's really 5% of your account. So you don't put more than that in any one trade. So if one of these goes drastically wrong, then you're not going to totally ruin your account.
That's always good. I think there was another question. Let's see. We've got a few different questions here. Do you want to move on to the next slide? I think it's the Oris stuff.
Yeah.
And I guess before you start going into all, we could just do this question. So does the profit loss for Oris matter on the direction of the stock price moves, or is it equal, whether it's up 10% or down 10%?
No, so it's it's definitely it leans bullish. So yeah, you want it to be that you want the stock ideally to be going up slowly, is what I would say. Because if the stock goes down, your Leaps call is going to lose money. Now, it may be offset by the rent you're collecting or the time value that you're collecting, but you would have been better off had the stock not gone down, because instead of offsetting a loss, that rent would just all be pure profit and your Leaps call would still maintain its value, right? So we definitely want it to stay either flat or go up slightly.
Yeah, and I think that's a good point, though. This might be one of the best times for a long time to actually start this type of strategy, right? Because it feels like, and we're not quite there yet, but it feels like we're starting to get a reversal. At least we have in the short term. But if you're bullish in the coming months, maybe you think this is the market bottom or close to it, this is like the perfect strategy to start, I think. Something else.
Yeah, totally. No, I was just thinking that, like, if this is of all times to start a strategy like this. I think now, because the downside, I mean, a lot of it has been taken out of the market. Like, how much further can the market go down? And just to kind of answer that last question about, stock that goes down 20 or 3%, you can also do this on ETFs or indexes as well, right? Which is one of my favorite things, because you don't have the stock specific risk there. And you're still collecting a nice premium. You don't collect as much premium sometimes on ETFs because they have a little bit lower volatility, but they are a lot less volatile. So you don't have those blowups as often with an ETF.
Cool.
All right. So I've got on my screen here. These are kind of the 6 steps that I talk about. And in the group and through the group coaching, and we got a online course. I talk about these different things, right? Finding the right stocks, placing trades at the right time. So all of these are designed to help minimize the risk of loss. Right? We don't start Oris on kind of your Wall Street bets type stocks for a reason.
Yeah.
Right. We want to try and find pretty stable, pretty big size companies that have positive earnings and cash flow, those type of things. And that's what the app helps screen and find.
Yeah, you guys are going to love the app. We're about to show it a little bit here, but this app is like a program you'd pay $2,000 for Rockwell Trading or something for, and it's included in this Stephen's Discord, which is amazing value. You guys are going to love it. So hopefully we can get onto that.
Yeah, and maybe we should. I'm trying to see how many more slides do we have. So I won't go through every single one of these steps. Right. I mean, that's kind of what the group is for, and the training is for. It would take us a while to go through all of them. This slide, I put it in here because I feel like, people start a new strategy and then, they have a loss, and then they think that that strategy doesn't work. And in my experience, just because you have a bad outcome, I mean, a lot of investing, right? It's just pure luck. There's a lot of luck involved. I mean, you could start a position the day before some big macro event happens, right? Mm-hmm. And doesn't mean that the underlying company that you're investing in is bad. It just means that you had really bad luck on your timing in starting the position at that time, right? And so don't get down on yourself just because you have some losing trades, or don't give up on a process just because you had a string of bad luck. And so really controlling your emotions and understanding that we feel the pain of loss more than the joy of gain. I mean, that really can mess with us psychologically, and it causes us to make bad decisions, in my opinion. There's a really good book on decision making called Thinking in Bets by Annie Duke. I highly recommend it. That kind of helped me with my investing thinking quite a bit. So really quick before we get to the app, these are the first 3 rules of Oris that I mentioned. So the first one is kind of, cash is king, have cash on hand all the time. I actually changed this is kind of a little bit old, but I really like to lean more towards the 50. This is don't invest more than 30 to 50. Yeah. So I put 30 because in a bear market, I actually think you should even scale back more. If you can, if you're seeing that we're in a bear market, you can even scale back more. Position size. So like I said, don't invest more than 10% of your investable cash in any one position. Now, a little caveat is if you're running Oris on a diversified index like SPY or QQQ or something like that, I guess I would not be opposed if you went more than 10%, because you do have a lot of the diversification benefit because you're investing in an index ETF, right? Something like that. But these are guidelines. The next one is stay diversified. So what I like to do, and what's been shown this year, right, more than almost ever before that I can think of in the last 20 plus years that I've been doing this, diversification really can save your portfolio, because if you look at, energy, healthcare, some of the utilities, consumer staples, those have actually held up pretty dang good compared to the rest of the market. And so if you were 100% in technology stocks or like communication services stocks this year, like you would be hurting a lot. Like those are probably down 50%,
Yeah.
those indexes, right? And
Yeah.
so the average, we're only down on average, the SPY, like what, 20%, because it's had a little bit of a recovery. And that's because you had other sectors that did well. So don't put all your eggs in one basket, right? Diversify your positions into different industries. And lastly, I think this is our last slide before we can show the app, but the Synthetic Yields Investing Club is what I call it. That is our Discord group. If you join, this is what you get. You have trade alerts and ideas. I try to do 1 or 2 a week. It really depends on the market. I mean, I don't like to push things when I really don't think there are good opportunities out there. So but we typically get at least 1 a week, sometimes 2, sometimes 3. You get access to the app that we're going to show in just a minute. And this is really something that I built for myself to find these setups, because I was just kind of, I needed a good way to find them. So I decided to build this app, and I thought it'd be great to make it available to everyone so that they could find their own ideas. Group coaching through Discord, right? Any questions you have, people will ask me about, hey, what do you think about this potential trade? And I'll give you my opinion. Case studies. So what I like to do is I like to create like some case study videos with like a accompanying spreadsheet, just to show you how Oris is working in real life. So I'll pick a name from my portfolio and just kind of show you the historical trades and the different decisions I made throughout, the process. And then you also get obviously access to the option rental income system, which is kind of goes along with the last point. It's the online course, how it works, the different rules, the 10 rules. So you get all of that as part of the group. Anything else you wanted to add, Russell?
No, I think that sounds good. I've been in the Discord for a while now, and the amount of due diligence that you're doing on this is really, really impressive. I think that's part of the value, right? It's a big part of the value is you're doing the due diligence and posting it into the Discord. But then with the app, you're also getting ridiculous amounts of due diligence on any ticker that you really want to look at. So, and basically spoon-fed the Oris statistics for each ticker. So that's pretty exciting. Yeah.
So let me try and show that for you guys here. So I don't know if you can see my screen. So I'm showing kind of what it would look like on your phone. I like to use it on my phone. So it's kind of like shopping on Amazon on your phone. Like I like to sit there at night and shop for stocks, like different stocks that I'm interested in running Oris on, and you can actually, so if I for example, this is a retail jeweler, Signet Jewelers, one of the biggest jewelry, I can't say that word, retailers in the world. You can add it to your watch list, for example, and it'll be on my watch list here. And
so it's hard. I'm having a bit of a hard time seeing the mobile.
Yeah. So let me go to the web version. So the web version's a little bit bigger, right? So if you're on your computer, this is a web app, so it'll work on your desktop, your mobile phone. You can actually install it on your phone too and make it appear in your list of apps, just like any other app, by the way. But yeah, so you'll get different, these are different stocks that I've kind of screened for Oris. You can also look at all stocks with weekly options, which is in this weekly stocks tab. And you can filter, so you can turn on the filters here, and you can filter, based on price, because maybe your account's smaller, and so you really can only run the strategy on stocks that are, less than $50, right? So you just put in the filter there, and it will automatically filter your results down. And you can say, I want to only look at stocks in the healthcare industry, because maybe you're heavy in the other sectors and you want to find a healthcare name, right? So you can filter it down even further. And so this is really a time saver for me. Let's say, you thought Pfizer might be attractive. You can see where it's been. It looks like it's been up a lot, but you can look at kind of the valuation metrics we got here. We got a fair value estimate. This is ingesting lots of data, and gets updated pretty frequently, probably every couple weeks gets updated. And you see kind of analyst targets. Down here is kind of my favorite part.
Yeah, mine too. I love this part. This is so cool.
I just added this the other day, and looks like it kind of messes up the look, but I'll have to fix that. But anyway, so you can see the Auris stats here. So this is Pfizer, right? So you can see a 30 DTE at the money call. You're going to collect $149 in rent. That's the extrinsic value that we collect. And if you buy a Leaps call, we're estimating it'll cost you between about $1,500 and $2,300. And so depending on how much you have to pay for the Leaps call, right, you'll get a return of 6 to 9% by placing this trade, ideally.
Cool.
So, and then we even have out of the money and far out of the money, like 10% out of the money. What's the potential return and rent look like? $30 for 10% out of the money, $14 for 20% out of the money. Nice. So yeah, I think this will help you make decisions.
Yeah, definitely. And so you can do any stock on here. It looks like you just search. I looked at AMD earlier, so I just had a quick look at that.
Yeah, so I'm kind of pre-screening. So it's really the universe of stocks that have weekly options. One part of this strategy is you want options that are liquid. And so if a stock has weekly options, then typically it means it's a pretty liquid stock with liquid options. And so we've kind of narrowed the universe down to stocks with weekly options, which there are about 600 plus stocks. And then from there, you can filter it down even more. But it's going to have all your big name stocks these days. They all have weekly options. Another tab that I really liked is this weekly ETFs tab. Like I said, I have grown to like running Auris on ETFs because you don't have that stock specific risk like I had with Intel, right? Yeah. And so I've probably got Auris positions on a lot of these, like XLF, XLC. These are sector ETFs. You've got country specific ones here. You've got gold, silver ones. I know some people in the group have been running Auris on silver for a few months now, and I think it's been pretty successful. That the prices just kind of trickled up. You've got, your broad index. Sorry, I've got my filter on still, so let me clear this. You've got broad index ETFs somewhere down here. So there's quite a few ETFs. I think there's 50 plus ETFs on here that have monthly options. So yeah, it's fun to browse. You can look through them, and maybe you're interested in Brazil and you want to just invest in the entire country of Brazil, right? You can go down and see, okay, I could collect $137 of rent per month, and I'd probably spend between $1,200 and $1,600 on the Leap call.
Isn't that cool? That's so cool. So somebody was asking what sort of amount of capital do you need? And so from this, you can get an idea that, you can't do this with $500 or $1,000. Do you have a minimum amount of capital that you'd recommend for people starting, given some of these numbers?
Yeah. And ideally, you could, if you if you wanted to, you could start with as little as 5,000. I would say 10,000 would be ideal, so that you could have 5,000 in cash and be investing 5,000. But that's probably what I'd recommend, is about $10,000 portfolio. Now, I mean, if you don't have $10,000, you have something less. You can still do this. You just have to limit your universe to lower price stocks, right? So something, you probably want to start screening for stocks that are below $20, and you might not be able to have, I would still recommend trying to have at least 5 different positions. So maybe you'd be limited to $1,000 per position, or, $500 to $1,000 per position.
Very cool. Very cool. So, yeah, I love it. So I've been looking at it every day and like, wow, this is so easy to use. So I've been pretty excited about it. Does anybody have any questions? We're going to probably go on a little bit here into like trying to give you guys more of an idea about like the whole list of things that you actually would get with if you decide to join Stephen's Discord tonight. We're going to do a coupon code off for you guys that have stayed to the end. It's very, very reasonably priced compared to most services. Like I said, what I'm seeing here is as good as something like Rockwell Trading's PowerX Optimizer, except it's nowhere near that price. And you get Stephen's expertise, personal help in the Discord and stuff. So maybe we should start running through like the actual Discord stuff. Is it easy for you to pull up your Investing Yields or Synthetic Yields website here, and we can just kind of walk through what everybody would get if they decide to join, and see if they,
Yeah. You want me to show the Discord, or you want me to show the website?
The website, if you could.
Yeah.
John's asking, what's your background trading? I think you mentioned at the start he's been trading for about 20 years now, primarily doing this type of strategy, right? The last decade or so.
Yeah. I mean, I've done almost everything. That's why I kind of concluded that this is, in my opinion, the best way to invest with options. I started back in 2010 with options. Before that, I was just investing in stocks. Yeah. But I've done spreads. I've done like far out of the money spreads, like put call spreads, things like that. But my problem with some of those other strategies, like spreads, they're so binary, right? You do a 30 DTE spread, and maybe it's still 20, 10% out of the money, but then something happens, and your $50 that you collect turns into like a $450 loss from some binary event. So this is kind of what I concluded was the best way to get consistent returns using options.
Cool. Yeah, if you could scroll down to the bottom where you have the list of the what we get, would be pretty helpful just to kind of get people going. So
So I've got so let me go to this page here for the club. I think I outline it. Oops, I'm logged in. So let me I think it's on this page too, but it might not be. I think it's just right here.
Yeah, so exactly. So in the Discord, you're pretty active in there. I've been in for a while now, and I see you're posting your updates and stuff. It's pretty cool. But you do the usual trade alerts on Discord, which of course can be pushed to your phone if you want to. This is not a crackhead day trading service though, so it's not like you get swamped with notifications. You're really only getting like the top ideas, but properly researched by you, which is awesome, which I really like. Synthetic Yields mobile app. This mobile app is awesome because you're helping people learn the strategy, but then they've also got a tool where they can just like type in a ticker, just go like this one, which is really, really cool. I love that idea. The group coaching stuff, you've been pretty open to helping people learn this stuff, which is really valuable. A lot of people that run services won't even like talk to people. So I like working with people like Lance and people like you, is that you're totally open to helping people actually get to grips with this stuff, which is awesome.
Yeah, totally. And it like, people have questions. Sometimes they'll just DM me, right? And we'll have a conversation back and forth for a couple days, right? So I enjoy doing that.
Cool. Yeah. And so the price for this is so we were talking about starting at $750 for a year, which is still a total bargain in my opinion. I've seen things go for twice that that are nowhere near as high value as this. But we had a discussion before we did this webinar. We're like, you know what? Let's do it for a small fraction of that. So I think you actually put together a couple of coupon codes, right? The first one is for people that are watching the webinar.
Right.
And so for you guys that have watched this, I've been watching you. Most of you have stayed around for the entire webinar. And I'm hoping that's because you're really interested in learning more about this particular strategy. And so what we're going to do for tonight is offer a discount code for, I think it was $300 off, right? I'm going to take it down.
Correct. Yep.
So I'm going to post the coupon code. It's right here. So if you go to syntheticyields.com, I've posted the link. And if you want to join, you can go to, and correct me if I'm wrong here, Stephen, but I'm assuming you can go and join and put in the coupon codes.
Yeah, so I think like I've already tested the coupon code, so mine is showing it already at the discounted value here. Because
right.
It's my computer's remembering that I had put in the coupon code. So if you put in the coupon code, yeah, it should drop it from 750 to
450, right?
Well, yeah. We had two. We had one that drops it to 500, really 497. I think I've changed it around a little bit. But the one today for the webinar, which I think is just active for the next 24 hours, is you get it for 450.
Yeah, so you just have to go to syntheticyields.com. I'm typing it in now.
Yeah, I mean, I don't know if you can, if you want to show your screen, you might show it better. But if you go to like join the club, I think mine's logged in, so I'm just going to log in. I think, yeah, I would have to. Try incognito window, and it probably won't remember. I think if you go to any one of these buttons, should take you there. Join the club. Yeah, so it's showing 750. So if you go to click join now, there's a box here for the discount code, right? So if I put in, I think SY
450, right?
450 was the code for the webinar.
Yeah.
I click apply. Yeah, then it takes the $300 off, right?
Right.
And you just finish the checkout process.
Yeah, and when you do that, you get invited to the Synthetic Yields Discord as well, which quite a few members already are in there. So Lance from Theta Traders is in there. Josh, Husker Nut Josh, he's in there as well. I'm in there. A few people are kind of overlapping into these Discords, which is pretty cool because we're starting to get like this integrated network of people doing this style of trading. But each of you guys have like a different take on it. So this is different from what Lance does, which is different from what Matt does. But there's an overlap where people can appreciate that this is a wealth building technique. It's not a get rich quick type of technique. It's like a slow and steady, conservative way to build wealth and to build cash flow over time as well. So it's pretty cool. We have another question, so I'll put it up again. So if you start with $10,000 bankroll, what stock price range would you be looking for? Like we were just saying, stocks in the $20 range or less.
Yeah, that's probably what I would recommend. I mean, maybe 30. Yeah, probably the $30 or less range. What I would say. Because that's going to put, if you ran Oris on a $30 stock, you'd probably need about, $1,000 to $1,500 per trade. $20 stock, you're right around $800 a trade, I would say. So yeah, that's probably about right. Less than $30.
Pretty cool. All right, let's get rid of that one. Does anybody have any questions? I still don't see there's quite a few people watching. John asked what Stephen's background. We answered that one. Let's see. Raj, do you have any questions apart from is she an active member? Is who an active member, Raj? What are you talking about here? Is she an active member? Did we mention somebody like earlier on? I think so. We'll see if Raj is still about. Not seeing any other questions. Let's see. Raj asked earlier, do you ever do this on SPY or the Qs?
Yeah. That's, like I said, it's one of my favorite strategies is, or I guess one of my favorite underlyings is these index ETFs, right? I haven't done it on, I don't have one on QQQ or SPY currently, but I'm thinking about putting another one on soon. But now the stock, the problem is the market has been up quite a bit over the last few weeks, right? So I hate to do it when the stock's going up quite a bit, right? So I'm kind of secretly hoping that stocks go back down a little bit because there's more opportunities when prices are lower.
Yeah, very cool. Starting to get a few other questions here. Just making sure people realize that the $450 price is only going to be for tonight, and then it's going to go back up to a little bit more, not the full 750. We're trying to get a good launch here and get people in and get the community starting to go really nicely. So, looks like we have another question. I'll post it up here. So saying, or instead of silver ETF, can you do it on silver future options?
Good question. Talk to Lance.
Yeah.
He's the futures guru. I don't really
Lance-
do futures. But based on some things Lance has told me, I think you probably could figure out a way to do this on futures.
Yeah. And so Raj is asking, let's see, get this thing up. Raj is saying, do you ever do diagonals that are with puts?
It would have been nice this year. So I think I've only done one. The problem is I bias more toward the market being long because generally the market goes up more than it goes down. I think like statistically it's 60% plus days are up days in the market versus down days. But yeah, you definitely could. So you could try and screen for the most overpriced stocks and do a poor man's covered put, essentially, right? You buy a long duration put and sell the at the money put. So yeah, it definitely could work, and it would have worked fantastically for most of this year, I think, on a lot of stocks because the general direction has been down. And so that's something definitely to explore. But now that the market's down so much, it makes me a little bit nervous to do a lot of puts, poor man's covered puts.
Cool. You see the question I just brought up from Aaron. So is the difference between the system and just selling covered calls? Is it that it takes less capital to obtain the same results? So that's a key question, right? A key core of this strategy is what the major difference is between selling covered calls and then doing poor man covered plus your rules.
And it's not to say that you can't do, like, by all means, if you want to do this strategy with covered calls, you certainly can, right? So you could actually have several positions. They're typically cheaper price stocks where I'll just buy the 100 shares. If I think the downside is limited, I think it's a pretty solid company, right? Just because there is a benefit in that your leaps call will have zero, your long leg, right, will have zero decay because you have 100 shares and that has no time value, no decay. It will just maintain its value. But you're using a lot more capital. And like I said, with poor man covered call, if the stock tanks, think Alibaba. If you were doing a covered call on Alibaba this year, then you're probably, sorry that you didn't do a poor man's covered call because that stock is down drastically over last year. And you would have lost, potentially 50 to 70. A lot of stocks, you would have lost 70% of your value. And if you had a poor man's covered call, the most you could have lost was maybe 35%, 40% at the most. right? And probably less than that because your Leaps call would still have some value. So the difference is you save cash that you can use for a rainy day. You have the automatic ratcheting system so that you have less and less exposure as the stock drops. And you just have a built-in stop loss because you can only lose the amount that you spent on that diagonal spread.
Cool. So more questions coming in, so I'll just keep putting them up.
Sure.
Let's see where we're at. John is asking, Stephen, can I ask you your opinion about doing straddles the day before earnings that has proven historically high volatility on earnings?
Yeah, I don't really have an opinion, I guess. I don't like to play earnings. In fact, with this strategy, I often will remove my position before earnings if I'm not confident that there's not going to be a big move. And I'll put it back on if things turn out okay. Right. I like to avoid earnings. I don't really play earnings.
Yeah, I don't either. I hate earnings. It's not good at all. Mike has another question. How does this work on stocks that pay a dividend? Interesting. Good question.
Yeah, so that's one thing you got to watch out for. So you can get in a position where you get assigned early on your short call if there's very little, if the time value remaining is less than the dividend that will be paid, and you're holding that position over the ex-dividend date. So that is something that, and actually, I'm looking at including the dividends, the dividend information in the app, right? So you can see like, okay, this has a dividend coming up on this date, just so that if you place that position, you got to be aware. Most of the time, though, what I'll just do is I'll just roll that short call. So let's say the ex-dividend date is in 2 days from now. And maybe that short call has very little time value left. I'll just roll it. Maybe it's not quite time when I would usually roll it, but I'll roll it early. So I'll essentially buy it back and sell a new one 30 days out and collect more premium. I'll just do that to avoid the dividend, because if you collect enough premium, if your new call has more time value than the dividend, you won't get early assigned. You just kind of avoid it. That's how I deal with dividends.
Cool, that makes sense. I'm just going to post the link again here, news.com. Yeah, so guys, I think I can post your email address, right? I think you put an email address.
Yeah. Feel free to shoot me an email if you have questions.
And so I just posted again the coupon code to join. You'll get the whole thing for a year for $450, total bargain in my opinion. That's $300 off just for tonight though, so it's literally a coupon code that expires within 24 hours. So we really want to try and get people in at a low cost like this while the services just started to really launch up and start to ramp up. Remember, there's always development going on with the app. Like it's really cool. I'm pretty excited about it. So we'll see. Let me post your email address into the YouTube comments as well.
Okay.
Here somewhere. So if you do want to reach out and ask Steve some more questions, here's his email address, so you can do that directly. So just posted it into the chat now. So often with these things, if you've got some questions, I know John seems to be looking to maybe join, but maybe doesn't quite know whether it's just right yet. Just send Steve an email. It's steve@syntheticyields.com, and you guys can chat and see if it makes sense for you to join and whatnot. Yeah. So any more questions? Have you got anything else to add, Steve?
I mean, thanks for joining. I know you've been with us for a little while now, so I'll let you get back to what you were doing before. But just want to point out that we're trying to price this reasonably. Calculated about $1.25 a day at that 450 price. And And actually, what I was thinking of doing, which I think would be cool, is to put a average daily rent, right? So you can see how much rent you would get a day on average from one of these Oris positions. Be cool. And I think hopefully we should be able to get more than $1.25 a day on a lot of these positions. So it kind of, in my opinion, pays for itself. Yeah, that's it from me.
Pretty good. Another question from John. Let's see. Can you talk briefly about the learning course? And that's something I haven't worked through yet. I've seen you do have some courses and things in there. Talking about those could be
Yep. Yeah. So the course is up on the website. I wonder if I can show it. Yeah, so you can see kind of the contents of the course. We've got like an introduction and different I think there's 6 different modules. So 2 of the modules weren't very good, so I'm going to do either a live session or record them. I had recorded a version that I wasn't very happy with. It wasn't very good. Audio wasn't very good. So there's a couple sessions of these modules that I will probably do live shortly as we get some more members in. But a lot of information's already there, so you can walk yourself through these modules. There's some videos. Some of it's just text-based. But it's just to kind of give you a good overview of Oris. Some of it is basic option stuff for those who have 0 options experience. So you can skip that if you are familiar with options. But it's just to kind of get you a basic knowledge of the strategy. And then you can, ask questions in the Discord to supplement what you learn from the course.
Yeah, that sounds really good. Yeah, for sure. So let's see. I think we're pretty much done. I mean, it seems like, does anybody else have any questions? Let us know. If not, I think we've been going an hour and 45 or an hour and 15. Yeah, pretty good.
Oh, wow. Yeah. Well, yeah, hour and 15, I think, right?
Yeah, time goes fast when you're having fun. Always good talking about this stuff. Any other general questions about the Oris stuff or about this type of sell-side strategy in general? Like, happy to field any more questions. Apart from Lance, we don't want Lance questions. Nope, all good. All right. Well, thank you very much, Steve, for coming on, and I'll send out a follow-up email to you guys with a link to the coupon code and a link to Steven's email address if you want to talk to him a bit more and stuff. And yeah, hopefully that was interesting, and it's definitely something I would consider adding to your toolbox for this style of trading. So yeah. All right, guys. Well, thank you very much, Steven, and you guys have a good evening.
All right. Thanks, Russell.
Thanks.
See ya.
Cheers.
Bye.
Bye.